Dow theory has its origins from a series of editorials and articles written by Charles Dow over 100 years ago. Dow's theory is based on the premise that a financial market as a whole is a fairly accurate indicator of business conditions within an economy. Charles Dow and one of his business associates, statistician Edward Jones, used the above principles to create the Dow Jones Industrial Average and the Dow Jones Rail Index to reflect the business conditions in the economy. In many ways, Dow Jones Industrial Index is a precursor to the technical analysis and the several stock market indices that have evolved over the years, applying the same basic principles enunciated by Charles Dow. The basic tenet of the Dow theory is that all information, past, current, and even the future, is discounted by markets and reflected in the price of equity stocks and equity indices. Perhaps it was generally believed the only information not reflected in the Dow Index comprises unknowns such as earthquakes, natural disasters, etc. Dow theory relies entirely on the closing price of the index to build a graph that shows the trends in prices and indices. It does not take into consideration the intraday movements. An upward trend is a series of successive higher peaks and higher troughs, and a downward trend is a series of lower peaks and lower troughs. Dow theory revolves around trend analysis and works on the basis that such trends in the index can be broken up into three distinct parts: primary, secondary, and minor. Primary trends will generally last between 1 and 3 years or more. Secondary trends, on the other hand, have a shorter time frame, typically between 3 weeks and 3 months, embedded within the primary trend. And as you can see in the graph on your screen now, an upward primary trend could comprise of secondary downward and upward trends. In other words, from a higher high to a lower high will be a primary downward trend. The secondary trend could be from a lower low to a consecutive higher low. The cycle time for a secondary trend, that is reversal of the secondary trend, could be 1/3 to 1/2 of the movements in the primary trend. As an example, if the primary upward trend moves from 13,000 to 15,250, the secondary trend could be expected to move downwards from around 700 to 800 points, which is 15,250 minus 13,000 divided by 3 plus or minus 50 points. The third trend is the minor trend, essentially subsets within the secondary trend and usually lasts less than 30 days. These minor trends are essentially market corrections that go against the direction of the secondary trend. Minor trends actually are of very little use to those who follow Dow's theory because they include too much noise that is generated by day traders in the market. As I said earlier, primary trends could last anywhere from 1 year to 3 years or more and comprise 3 distinct phases. First, the accumulation phase, which is the start of the upward trend when informed investors enter the market. This phase begins at the end of a downward trend when the large macroeconomic scenario is seemingly at its worst. At this point, the equity stock is at a low and hence the downside risk is very limited. Needless to add, it is always difficult to determine this inflection point because the broad sentiments in the market arising from the preceding prolonged downward trend would be characterized by market sentiments and the belief that the situation could only get worse. This new upward trend would be established when the market does not move to a new low. Instead, it takes a U-turn. Next phase is the public participation phase. Remember, informed investors, as we saw in the accumulation phase, entered the market during the accumulation phase in the explicit belief that the worst is over and better times would follow. Once this sentiment is perceived as being reasonably consistent, the market enters the second phase, which is the public participation phase. In this phase, negative sentiments start to disappear, supported by improved macroeconomic conditions and earnings growth. Once that happens, more investors enter the market, resulting in a sustained upward trend. The third phase is called the excess phase. This is when the market heats up and enters the phase where prospective investors are consumed by an irrational belief that only good news and good performance will flow going forward. At this stage, the informed investors exit the market in all probability, signaling the start of a primary downward trend. What we discussed in the couple of minutes that have gone by is in the context of a bull market, when the market trends upwards. The same truths and axioms will hold in a bear market characterized by a primary downtrend embedding a public participation phase and then the panic phase where everybody wants to exit the market. The worst of the bear market, that is a primary downtrend, is arrested when informed investors enter the market at the low levels and the accumulation phase of the primary upward trends commences, and then the cycle repeats itself. The volumes traded in the market is a significant indicator of the signals provided by Dow theory on upward trends and downward trends. For example, if the market is in an uptrend, however, the volumes traded are weak, it is perhaps a signal that the uptrend is beginning to dissipate and is a commencement of a downtrend. As per the Dow theory, once a trend is established based on the volumes traded, much of the activity in the market will move with that trend and not against it. In a sense, the fundamental tenet of Dow's theory is that a trend in the market is sustained until there is a significant evidence to suggest that it has been or will be reversed. While the basic principles on which the Dow theory was built holds true to this day, complex macroeconomic factors, globalization of markets, increased cross-border investments, etc., have posed several challenges to the Dow theory, requiring the analysis of many more factors that have potentially reduced the predictive accuracy of the Dow theory. Be that as it may, Dow theory in its broad form continues to be important for technical analysis given its strong foundation, uptrends, downtrends, peaks and troughs, and its ability to incorporate emotions in the marketplace.